right, everybody. Good afternoon, and thank you for being here for the last session of the day. There's a few empty seats because people haven't figured out that short duration and high yield is the place to be.
Sure, if you want to make money.
If you want to make money, absolutely. Also, I know that if you're ever asked to speak at the Javits Center, you accept. So I'm very pleased to be here, as are my panelists right here. I must admit, though, when I walked in this morning, I had been at the first LendIt conference 5 years ago in San Francisco. There were about 200 people. And seeing an industry that literally started 10, maybe 11 years ago maximum, and walking into the Javits Center to see the signs and the people and the excitement level, it's absolutely incredible. And this is an industry that has popped out of nowhere for all the right reasons, and it's here to stay. So I think we're all very, very proud and excited to be a big part of it. So just to start off, I'm Justin Brownhill. I actually founded in 2007 one of the early small business lending companies called the Receivables Exchange. I'm now the managing partner of a merchant bank focused on financial technology called SenaHill Partners. We make investments and we do boutique investment banking. And I actually have 3 investments in this specific space. 2 small business lenders, Foundation and Internext Capital, and a consumer lending company called Bristol Cone as well. But more importantly, we have 4 founders and experts and operators of 4 very fast-growing and excellent companies in the space. So what I'd like to do is just introduce them one by one and just ask a very basic question as per the title of this panel. I will start with, right here with Phil from IOU Finance. He's a fast-growing small business lending company based up in Montreal. And by the way, we have kind of North America covered here with New York, Montreal, Detroit, West Coast, and Chicago. So I think we've got a nice sample set here. But Phil, maybe you could start off with a basic question. What do you consider short duration? And what do you consider high yield?
Okay. So we consider short duration effectively loans with terms that are less than 18 months. So anything that's a 4, 6, 9, 12, 15, 18-month loan we'd consider short duration. Anything longer than that, I think you're getting into a little longer duration, and we wouldn't qualify that as really short duration. In terms of yield, of course, high yield means that you're probably going, in the down the credit spectrum a little further than, say, kind of the banks. And so high yield will different, as the word implies, means higher returns, basically to compensate for the increased level of risk. And so no different than in the bond market where you've got investment grade paper and you've got coming a high yield paper. Well, the investment grade paper is maybe yielding 3.5%, 4%, and investment or higher yielding BBB and below is probably yielding 5, 10%. And so you're kind of going along that credit spectrum into kind of a higher risk, higher return, higher yield lending.
Great, thank you. Next one down is Ryan Rosett. He's founder, Chief Revenue Officer over at Credibly. Nice to have you here too. And I'd like to ask the same question of you. What do you consider short duration? What do you consider high yield?
Great. Thank you. So I would say on the duration side, anything less than 24 months, I'd say is short term. Our typical products range anywhere from 6 months to 24 months. Standard products, sort of hovers between 11 and 12 months. In terms of yield, I would say high yield, just given the majority of what we do is a daily remittance product. The longer term product we also do a weekly pay, but the way the APRs work with daily pay is it gets elevated. So anything above 100% APR to us would be considered high yield.
Terrific. So thank you for that. So Ben Gold from a company called QuickBridge, which maybe the name dictates that you might be even shorter duration, yes. But we'd love to ask you the same question, please.
Yeah, I'd say specific to sort of what we do, the short-term working capital loans, our average duration on file is about 6 months. So for us, anything longer than 8 months starts to get a little bit sketchy. We see in our portfolio, difference between a 4-month deal, 5-month deal, 6-month deal, 7-month deal, and 8-month deal, and how each of those perform. So we take it very serious in terms of our credit grades anytime we go out further in duration. And I'm glad Ryan mentioned 100+% APR before I did. I would also consider that to be high yield. I think really for us, and the world we came from before was equipment leasing, which wasn't as high yield, but still high. I think anytime you, to the general public, or if you're at Thanksgiving dinner and your family asks you what are your rates, and you have to dance around the question, it's probably a high yield. So all of us are high yield for sure.
Terrific, thank you. George is the CEO and founder of LQD Finance. It's a comprehensive solution for a whole bunch of small business lending products. And I'll ask you the same question. How do you think about that?
Yeah, so I think if you were to ask the market, I think 6 to 9 months is typically considered the short duration sweet spot. Nobody goes over 12 months typically and calls it short. From an APR perspective, I think the floor is 40%, and anything above that's getting into the quote-unquote high yield, at least in sub $100,000 sort of daily pay type loans. Our product is a little different, so our average ticket is several orders larger than the typical MCA ticket. We push closer to 500,000 on average. We're lending into more organizational businesses as opposed to smaller sole proprietorships. So in our case, a short duration would be 12 to 18 months, and a high yield would be in the low 20s, as opposed to sort of what that might be considered in more traditional short-term working capital or merchant cash advance.
Terrific. Well, when you think about equities that have 3 to 5 year holding periods and an expected return of 8%, you can see why we're in the Javits Center here. So, so keep up the good work, everyone. Obviously, you guys all have similar but different products, right? You're all focused on the small business owner and the small business financing needs. But maybe you can talk a little bit about the asset classes you have and what you believe your borrowers have as alternative financing sources that they're evaluating when they hopefully decide to pick your product. Maybe start at the end with you, George.
Yeah. So one of the things that we really try to focus on is the operating cycle of the borrower. One of the issues I think that we have, particularly with organizational businesses, is if you have a borrower that has a 30 or 60-day operating cycle, let's say, if you give them a solution that has a daily pay, then mathematically you're taking their cash needs and you're making them much, much higher, which means now they have to borrow more because they're running a higher cash deficit in between operating cycles. Now, there are businesses for which a daily pay makes perfect sense, and specifically those are businesses where you have daily operating cycles, restaurants, beauty salons, people where there's someone coming in and punching a ticket every day. What we try to do is we try to focus the payment terms both based on need. So, whether we do a term loan or a line of credit, because we offer both, we look at, is it a capital cycle need or is it an operating cycle need? And let's put the right financing structure in place first. Let's not assume everyone needs working capital if that's not the case. Then the second thing we're going to do is we're going to look at what the right amortization period is in the case of a term loan. You cannot underwrite, amortize a 5-year small business loan at a single-digit interest rate. It just doesn't make any sense. If you were to do the same thing in the S&P, you'd get 8% on average over that same 5-year period. And mathematically, no single small business loan, which is what you're sort of concentrated in, represents less risk than the entire S&P. So we look at that as a floor for pricing, right? The other question then becomes, if it's a working capital need, do they have a 30, 60, 90-day billing cycle? Because if we give them a weekly pay, let's say, but they've got a 60-day operating cycle, we're actually increasing the likelihood they can't service the debt because they're running cash deficit. So we really try to focus on the specifics of the business and the operating cycle need and then match the loan to that particular requirement.
Terrific. That's excellent. Ben, can I ask you the same question?
Yeah, I mean, for us, it's pretty simple. We're generalists. If there was any level of concentration in our portfolio, because of our background in equipment leasing, we tended to go more towards the blue collar SIC codes. And to George's point, I think a lot of the guys that, historically, merchant cash advance or daily payment loans were more designed towards retail, restaurant, high transaction businesses, and that just wasn't our background. We were more comfortable with somebody that was a little bit more blue collar. Maybe they didn't have the deposits, but at the time, back in the day, we would try to tailor these things a little bit more. Now it's a lot more systematized, so really we just put them through the process and hope for the best. What was the other part of the question? There was the asset class. So I'd say like our top SIC code is still construction, especially trade contractors. I mean, as QuickBridge, who else has a 4-month project where their margin on the project will far exceed whatever the interest expense is? And that's what we're selling against. In terms of like how we get in front of a customer as opposed to somebody else, we have a couple different channels. We have the broker business, and we built a lot of relationships with broker partners over the past 6 years. And we've been real fortunate there where they've provided us on the wholesale side a lot of opportunities for looks and learning about different types of businesses to fund. And then, we also use direct mail to reach small business owners. And really there, it's just a numbers and data game. And you hope to get in front of the right customer at the right time and that they have a need and they call and the stars align.
So Ryan and Phil, you guys have big backers in the big name private equity players. Apollo, FlexPoint Ford, some tremendous blue chip guys. From an investor standpoint, kind of how do they think about your space? How do they think about the returns? How do they think about being associated with you? And and how's the working relationship, and how do you think about it the other way around?
Great.
Go ahead. Yeah, go ahead.
So our excuse me, we have a partnership with FlexPoint Ford. It's about a $2.5 billion private equity firm that's based in Chicago and New York. They made their investment in our platform August 2014. It was the time they came in, I think the values were higher than they are today. Things have changed in the market such that there has been some shakeout, and there has been some companies that have either closed down or are experiencing some issues. That said, the fundamentals of the business are still exactly the same. The unit economics are the same, and we're actually starting to see some rate increases across the board and duration starting to tighten. So there was a period of time, I would say not too long ago, probably 6-8 months ago, where term was extending out 24 plus months from certain lenders, and it wasn't necessarily working well because there wasn't enough historical data to prove whether or not these loans would perform. So we have always stuck to our knitting, and we continue to do what we do. And I believe the relationship that we've had and foster and continue to grow with the private equity firm has allowed us to secure really good senior credit capital and to continue to grow and build out our technology, data science team, and platform as planned. So
terrific.
Good.
Excellent.
I would agree with Ryan. I mean, I think if anything, 2016, if you want to call it a shakeout, has brought to investors' attention is that this is fundamentally what we're doing is non-prime lending. It's not bank lending, and so what you saw is a lot of investors, whether they're equity or credit investors, come to the realization or that hey, this is non-prime lending. And what's happening in the space today is you are seeing underwriting standards tighten. You are seeing terms shorten. You are seeing pricing increase, and that's already started. It's going to continue most likely throughout 2017. So there is, so I think that, 2014, 15 were growth years, but I think 2016, if anything, made it was a year where it's a little bit more sobering. But as Ryan mentions, I think the economics are still there.
Excellent. So I'll stay on investors for a second, Ben and George. So some of you guys started out as marketplace lenders, but now I think everyone on this panel is largely on balance sheet, maybe with a little bit of hybrid component, but predominantly balance sheet lenders. How do you and your board of directors think about that, and is that the right model? And whether you started that way, is that the way that you think the winners will be, and what are the benefits of having a committed lender? And do you have mezz lenders as well, or do you guys actually take some of the exposure on the first loss after the advance?
So our thesis from day one was that sort of the marketplace model wasn't going to be sustainable. And we were just making sort of a simple empirical observation that said, you have a business that gets incentivized by volume origination, right? It takes 100% of the risk and it passes it off to investors. That's never worked. In the history of finance, that model has never been sustainable because you are incentivizing the originators to act irresponsibly. If I said to a home builder, look, put up as many houses as you can, as fast as you can, and I'll pay you for them. And if they all fall down, don't worry about it. You'd think I was crazy. But somehow when it comes to loan origination, this makes perfect sense. And then we get surprised when charge-off rates are 3 times what were predicted and people are acting badly. So I think that the model of the future, particularly with some of the headwinds that you're facing from sort of smart institutional money, is going to require an alignment of interests between the originators and the credit facilities that are coming into place, especially now that the banks are shaking at the knees after recent events. So if you're going to be looking for securitization money, if you're going to be looking for bank warehouse facility money, which is sort of the predecessor, there's going to have to be an alignment of interest, which requires you to carry on balance sheet. And the secondary thing I would say is that the original alternative lending model was focused on making the origination process more efficient. And it took the quality of the credit and the rigor of the underwriting process for granted. And the next generation model is going to come back to focus on not just quantity of loan, but the quality of the loan. And I think the companies that'll stand are the ones that are going to be able to deliver asymmetrically high alpha at reduced beta as a function of market supply demand economics rather than hyperbolic risk taking.
Ben, you agree?
It's cool. I do agree that there's a misaligned incentive on the marketplace, exclusively marketplace lenders. QuickBridge's story, we started off, it's kind of a long story, but basically it was an investment vehicle for 2 wealthy dudes, and they stuck Jason and I in a room together, and I said, you guys figure out which deals to buy and which ones not. And so we started off, we're wholesale is sort of in our DNA, and I'm a credit guy. So yeah, absolutely. I want the deals to perform, and us being stewards of the money of the people who gave it to us, that was the whole thing. So we care very much about the quality of the portfolio and why our worldview hasn't changed over the past 6 years of the amount of duration and the size of the loan and everything else that occurs. Now, the marketplace, depending on whose opinion you're after, has lapped us as it relates to longer durations and more dollars and everything else, and you're starting to see some of the fallout of that. But yeah, absolutely. I think it's important. I now understand the fact that we have a part of our company that does retail where we need to monetize our marketing spend on customers that either we're not comfortable lending to because of credit profile or the dollar size is too large, and we need to align ourselves with other lenders like a Credibly or an OnDeck, you name it, right, who are willing to do larger deal sizes that maybe we're not willing to do. So there's an opportunity there. I totally get it on the syndicate side, but because of our wholesale DNA, when we do sell off a deal, we care very much about, gosh, did we do all the right things? And before a deal even makes it through our process, we've really scrubbed it through. So I do think it's important that a company that lends money has some sort of underwriting DNA and some history of on-balance sheet lending, servicing, billing and collecting, everything else, so that you know the right questions to ask, that if you do end up selling off a portfolio of loans or anything else, you know what's gonna occur on those. But yeah, I mean, it's clear, and this is being proven out, that a strictly marketplace lender is going to have a challenge. And I think a strictly balance sheet lender that literally does nothing other than hold deals on their own balance sheet at some point is going to come across where you have an opportunity to sell a deal off to monetize that marketing spend. And maybe that's not worth it.
Yeah, no, alignment of interests, 100%, I get it. So you guys are obviously all proving that you're good stewards of some pretty big bank and institutional capital. But you guys are obviously selling product to small businesses with short duration and high yield. So who are these borrowers? What attracts them to you? And are these guys short-term borrowers, or are they short-term borrowers that end up just short-term borrowing for a long, long time? And just kind of curious as to kind of what is the benefit and the value prop that you bring to small business America and Canada?
So I think I'm probably a little different than these 3 guys. But so what LQD does is we seek to provide capital markets structuring sophistication to small business, right? So if you're in the middle market and you want a $50 million facility, there's 30 ways you can skin that cat, right? But it's going to take 120 days and it's going to cost you $100,000 in diligence and underwriting fees. If you're that same credit risk borrower, in other words, just outside of bankable, and you're looking for $1 million, you have no equivalent capital markets type product, right? Where you can get a revolver and a term loan and the whole gamut of facilities in a one-stop shop. So the reason we're able to generate the yield we're able to generate is because our borrowers simply don't have other places they can go where they can get the gamut of capital markets products under one roof. They may be able to go to an AR factoring company for that, an equipment guy for this, but that's fragmented. So what we do is we say, look, we can give you all the products a bank can give you, but we're going to customize it and give you greater flexibility with the capital, and in return, we'll charge a premium. Because there's no one else, or very few people at least, I would say, doing that, we're able to extract a premium just vis-a-vis the market supply-demand dynamics. And we look at our borrowers as long-term borrowers who are sort of graduating to ultimately bank financing or middle market financing at some point. And our opportunity is really in that growth phase, that 1 or 2 year growth phase, where they're transitioning from, call it 10 to 30 employees, or in some cases 30 to 60 employees, and they get too big for us.
Ryan, who are your customers? What do they love about it?
Yeah, so I would say our customers are, typically they're going to be it's going to be a whole range. I mean, so we're doing a ton of business with, you know, the traditional Main Street businesses, so the dry cleaners, nail salons, day salons, beauty shops, flower shops, aftermarket auto, restaurants. But then we're also doing just a ton of business with just regular small to medium-sized businesses as well. It's not, we're not, we don't view our customers as we do look at the lifetime value of them, and we are hopeful that there's an opportunity where the funds that they're using will be used correctly to increase their efficiency, whether it be putting a patio on their restaurant where they're adding more tables and they're creating more cash flow, or buying another piece of dry cleaning equipment, or whatever the case may be. But it might not always be that. It might just be a cash flow issue. And if there's an opportunity, we're constantly looking at it from a data science standpoint, making sure what products are available to them, when they're eligible for additional capital, and really retaining them. If they're able to go to a bank, they should, if they can wait. It's going to be the cheapest, best solution. What we bring is we bring speed, we bring efficiency, we bring customer service, and I would say with a surety of funding. That's really what we're bringing. If somebody has an opportunity where they need $15,000 because they could buy something for a 50% discount, that's a great use of money. And if they can get that money in 24 hours, what might take them 60 days from Bank of America, I think we're an excellent solution for that.
So Phil, what happens if they can't? If our industry doesn't exist, what happens to these guys?
Again, this is fundamentally, they do come to us for speed and conveniency and simplicity of applying online. But like you're saying, to answer your point, this is, again, it's fundamentally a non-prime lending industry. So if we don't exist, banks are not necessarily in the position to lend because either the small business doesn't have any collateral or just doesn't have the collateral that's necessary for a bank to lend, or the owner's credit is less than perfect, or there's already other debt that's tied to that business in terms of bank financing or some sort of equipment loan. Then you're basically further down the capital stack, and of course there's incremental risks there. So again, and you're getting compensated for that risk by the higher yield or the higher rates that you're charging. And so if we're not there, well, then yes, it would be that much more difficult for these businesses to access capital. And sometimes they're accessing capital for really the right reasons, which is to expand quickly the restaurant, to increase their marketing spend, and to really generate a return on that money.
Can I just add one little point to that? Please. So, there's this fixation on rate, right? So I come from a capital markets background. When I talk about 24% interest, let's say, oh my God, highway robbery. I mean, never mind 80%, okay? But think about it this way. If I give a business $1 million at 24% APR, okay? That's $240,000 of interest expense a year. That business takes that same $1 million, buys $1 million in inventory. Let's assume that they mark that inventory up only 20%, okay? Now they flip that inventory 5 times a year. That's, you know, $1 million in gross profit that they just made, that but for the $1 million I gave them, they would not have made. I don't know anybody that doesn't trade $240,000 for $1 million. So what you're seeing from business owners is not that they're stupid. I had an ABL guy from a very big fund last week in Vegas ask me, you know, how do you get these people to pay their money? Are they stupid? I said, no, they're not stupid. They don't look at it as a rate anymore. They look at it as an OpEx item. It's a cost of doing business. And when you put it into the fundamental economics, capital that generates positive return on leverage, notwithstanding the rate, is a good business investment. And that's where it comes. Now, there's going to be a point at which the price is so egregious that no business can afford to make money borrowing your money. And I'm not here to comment on what that number is. But at least in our case, the economic argument is very, very simple. It's simple arithmetic. You take this money, you flip it this many times, this is how much you make, deduct my interest expense, where's the issue? So I don't think we should get hung up on the face value of the coupon, because that's not where the value that we're providing is.
No, that's a great point. Now I'm going to turn it over to the panelists to ask one question to one or more panelists. Maybe, Ben, I'll start with you for you to direct a question to all or anyone on the panel that you would like.
Yeah, I'll ask my good friend Ryan. You know, I know data and data science is an important part of their business, so I am curious about how you guys look at data science as it relates to risk-adjusted and duration, and how that sort of plays into the mix. It's a great question. Thank you. Thought of myself.
So really, what we sort of pride ourselves on is the data science side of our business, and really having a robust team, and everyone, you know, will say there's a data science team. We have a very collaborative group that is looking at every metric, and it's running through our entire company. So from portfolio management to early warning triggers, so we're constantly watching our portfolio, which is just as important as making a loan, is tracking the portfolio. So, I mean, we're getting daily pays, so we're seeing when there's a skip payment. We know when there's 5 days DNR or no payment. So we're constantly have collectors on top of them, just in the event that there's something going on, or if they need a little break in payment. And then not to mention the scoring method. So in how we look at the business, from the health of the business and how we score it up front on the underwrite. It's just a very instrumental part of how we do business, and it's something that we take a lot of pride in. And it's to me, who with the investment from FlexPoint forward, and we built out the data science team, it really has made a dramatic difference in our loss curves and how we continue to grow the business.
Yeah, it's critical. It's critical. Phil, do you have a question for any of the panelists?
Sure, I was going to ask Ryan a question, but since you just answered, I'll ask Ben. Do you view yourself as in the fintech spectrum, more of a finance company or a technology company when looking at kind of the fintech spectrum?
I got to be careful, because we play like fintech bingo at these conferences to see how many buzzwords we can hear. I will say, as much as I'll get made fun of and the chills will come, that tech-enabled lender thing is definitely us. So QuickBridge is, by no uncertain terms, a company that lends money to small businesses. We've never pretended to be anything other than a lender. The technology part, which we've invested a lot of money into over the past 5 years, and the data science as well, has really helped our business scale and provided a lot of efficiency and consistency in day-to-day. Especially when you work with, a lot of different broker partners, a couple different, we have different channels of origination. And the great thing about having the important part of technology is really to get to the data. So for us, we're always asking ourselves different questions, and the data part's really cool when you lend money at short durations, because it shortens the learning curve. So you can learn something about a vintage within 2-3 months, because, as Ryan mentioned, you get the daily payments, you see kind of early losses and things like that. You can go back and fix whatever you learned from that time to apply it very quickly. The data means nothing, like the old saying, garbage in, garbage out. The data means nothing if good data doesn't get in the system. So we really use our technology to get good data in the system by making it the easiest way for all of our people at QuickBridge to do their job. So if everybody finds the system that we built to be easy to use, then they're going to use it, and they're going to use it in the way that we would like them to use it. And then as a result, we're able to extract the data out give it to our data science team, which tells us what to do, which we then disagree with, and do whatever we want anyways. It's a different thing. And
So
then
does that make it kind of tech and quant enabled?
yeah, so we're totally tech quant enabled. We've got all the bells and whistles that you would need to consider ourselves fintech, right? But we just don't like to think of ourselves in those terms. Really, we're a company that lends money. It just so happens that the technology helps our process, it helps us extract the data, and the data really helps us make better decisions. It's as simple as that.
I got 2 quick questions before we have the crystal ball question. First question, George. Pizza. Chicago pizza or New York pizza?
Oh man,
You're right.
I bought like the leading brand of Chicago deep dish pizza in my former investment banking life. New York pizza, Joe's specifically.
Joe's is
In
good.
Chelsea.
I like Grimaldi's, that's good. And then Phil, Montreal bagels or New York bagels?
Montreal any day of the week.
All right, we'll make-
Montreal bagels. So.
All right, just thought I'd line up. Before I ask questions of the audience, just want to kind of get a final thought or the kind of the crystal ball, which is, and we'll start with George and work down. What is your current view of the kind of alternative lending industry and where it's going? And I'd love a prediction for 17 and beyond as it relates to short-term small business finances like yourselves.
So I've kind of been on the record for a couple of years being outspoken about this. I think you have 2 fundamental issues. I think that, the marketplaces are sort of seeing a bit of a reckoning, particularly the smaller players who weren't super well capitalized by VC, because I think there wasn't enough focus early on credit and risk, and it's starting to haunt people. I think the MCA space, I think there are a lot of players in MCA that are trying to act responsibly and trying to run a good business. So I don't like to cast out the whole industry. The issue is that there is so much rampant, malfeasance, for lack of a better word, by brokers, by, pop-up MCA industries that are stacking and arbing everyone they can get their hands on, that the question becomes, how do you inoculate yourself from this metastasized, cancer? And, at the end of the day, you have to address reality. People don't want to think about what's going to happen. So in my opinion, I don't think it's any secret about what happened recently at Can Capital, and people were sort of shocked about that. I think it's just the beginning. I think that you're going to see, the chickens come home to roost, and that a lot of the players who were built on stories rather than good, sound credit decisions. I agree completely. Technology is in our DNA, but we're fundamentally credit and risk guys who use technology to make better decisions. Mm-hmm. Right? We're not guys who are tech and account generation guys trying to do credit. So I think you're going to have a shakeout. And one of the things that's going to be the impetus of the shakeout is a lack of liquidity from the large historical institutional investors. But I think that by the end of the year, that'll start to even out. And I think in 2018, you'll see that the companies that survive are the strong ones who focused on systems, who focused on governance, who focused on best practices. And ultimately, that's not only going to be better for the industry, it's going to be better for the borrower. So I think we still have a correction to go through, but ultimately, I think it's going to be a good thing. And ultimately, I really believe that there will be a long-term partnership between banks and alternative lenders.
Absolutely.
That will be the sustainable small business lending model.
Yeah, I think they're going to need you for that. Ben, anything to add in your predictions?
Yeah, I could just speak to sort of our space. So, for us, it's so top-heavy, right? Where On Deck and Can represented such a large percentage of the originations and sort of the daily and weekly debit, short-term working capital space that, everybody's like, well, how's the industry doing, right? Because it's sort of those 2 guys as the bellwethers, and then you've got, to George's point, a whole bunch of other guys on the other side of the spectrum that are like fly-by-night, and they're, opening up new shops all the time or rebranding, and, not always the most scrupulous of characters. So there's quite a few companies sort of in between that are just sort of plugging away and maybe not making as much noise, but still doing quietly very well. And I think to the point you made earlier about the growth of this show and just the growth of the industry and how young it is, it just takes time, right? And yeah, there's going to be George is spot on about the fact that, look, we saw this in equipment leasing in 2007 and 2008. As soon as the liquidity stops coming in, then all the chickens come home to roost, and it comes quick. And a lot of the times, a lot of originations on the front end can wash away the sins of maturing vintages. And as soon as the originations channel starts to slow down, to any level, all of a sudden those percentages don't look as clean. So I think as soon as there's any kind of liquidity issue, which at some point will occur, it will cause an issue for some lenders in the space. But I think as a whole, there's a need for us. There's always been a need for non-bank, short-term, just-in-time financing, to be sure, and there always will be. So I think the industry is fine. I don't know about everybody in the industry will be fine.
Yeah. Ryan, anything to add?
Yeah, I tend to agree. I mean, I actually think the strong will survive. I think being a credit shop is a important differentiator. Being an originator is definitely a skill, and there's a need for originators. But I don't believe you can be. I think if it's either runs in the blood of your organization that you're an underwrite credit shop, or you're an origination shop, and it's hard to have both. I think. We like to think of ourselves as credit and underwriting, and really having some strong discipline around that. I tend to wear more of a salesman hat, just because that's sort of my role, is just bringing business in. But I think the industry is experiencing definitely a downward trend in terms of perception. But like I said before, I think the fundamentals of the business haven't changed at all, and some of the irrational pricing is being taken out. I think there will be some other players that will probably fall. I don't know exactly who, but I just think there are some other players out there that will have trouble making it through sort of this next 6 to 12 months. And I think it is 6 to 12 months. I don't think it's necessarily a super short-term period, but the strong will survive, and I think it's going to be a much better days ahead of us.
Terrific. And do you want to finish this off here, Phil?
Yeah, no, I'd agree with all of the other panelists. I mean, I think a few things are, if you're going to look out to 2017, maybe number one is, again, as I mentioned at the beginning of the panel, loan terms are likely to get shorter. You're going to see loan amounts, more rational loan amounts, and I think you're going to see pricing go up. That's one, look out to 2017. The second thing is, I do agree with the other panelists that capital is going to become, less available, and it's probably going to flow to originators with longer track records and more proven track records in terms of origination and managing that default risk. And the third would be, I think, this has been talked a little bit about around the conference, but there, you may see some M&A activity or some closures, throughout 2017 in light of the capital constraints that we're going to see. It may force some closures, or it may force people together.
Can I just add one point to that?
Yes.
All that being said, this is the single best time for investors to get into alternative lending, period. 4 years ago, you were paying multiples that were completely ridiculous. If I'm an investor, if I'm a VC, if I'm a PE fund, this is the time I'm looking to make bets, because the winners are very easy to identify. It's not that hard. You can identify the winners, you can make a good bet, and you can get in at the right time and pick up the up curve. So notwithstanding, I think, the fact that there are corrections and we have to be sober about the exogenous world, this is arguably the single best time for investors to get into alternative lending.
Yeah, I agree. As an investor, I prefer multiples to book than multiples to origination. Look, I think, the state of the union is mixed right now, but it sounds to me what I'm hearing from the panel is you need to have a strong credit culture, right? You need to have a good quant tech infrastructure. You need capital, especially during illiquid times, and it's going to happen for some and many. And one thing you didn't mention, but I've enjoyed getting to know you guys, is you need a strong management team and leadership team and governance throughout the organization. And then it's interesting about originations. Originations is really about cost and marginal utility. In the end of the day, it's about unit economics. What's your cost of acquisition? What's your lifetime value? And can you just make that scalable? And I think we're one man short because we lost one company. But I have a very strong sense that all four of you will be up here again next year and continuing to grow like you have in years prior. So thank you very much to the panel. We don't have time for questions, unfortunately, from the audience, but I want to thank all of you for your time today. Thank you.